This segment sponsored by Foster Financial. Welcome to Wealth Wednesday, where we provide you with holistic financial advice from Foster Financial's Vice President, Caleb Doan. Good morning, Caleb.
Good morning.
How are you?
I'm doing well. How are you?
Good, doing good. Well, so much is growing and changing. We are now in May, and I know that there are some big changes that are happening in the market. So share with me about the recent growth trends.
Yeah, absolutely. I know it's always good to kind of take a step back and look at what's happened maybe year to date or over the past year with the market. Yeah. And we've seen things, go up, which has been really great. That's the direction we like to move. A lot of times when people think about, looking at what the market has done, people typically think about the S&P 500.
Okay.
And so, the S&P 500 is up really big over the last year. But one kind of interesting caveat about that is it's really the top 7 companies in the S&P 500 that have carried it so far.
Oh.
So sometimes people they know that the S&P 500 is made up of, 500 companies,
right,
of course. But one thing people might not realize is that it's not evenly distributed between those 500 companies, the kind of weight of the index. So the top 7 companies, since they're larger companies, make up a much larger portion of the S&P 500. So if it was just evenly distributed, 7 out of 500, that's like 1.5%.
Yeah.
In reality, those top 7 companies carry about 30% of the weight of the S&P 500.
And so what does that stand for?
S&P, it's like Standard & Poor's, 500. It's just like a rating agency now, but they're just the ones who originally created that index, and it's supposed to be an example of how the overall economy is doing, just looking at those top 500 companies. But since those largest companies carry such a big weight of the S&P 500, sometimes you might not get as much diversification as you think you're getting within the S&P 500. You think you're across these 500 companies maybe evenly. In reality, if you're in a S&P 500 index fund, 30% of that investment is just in those top 7 companies.
Okay, so these are the top 500 companies that are performing best, or that people are more likely to invest in?
Just the largest 500 companies in the United States.
Okay, gotcha.
Exactly.
And so people are kind of moving around their stocks to diversify it by investing in these specific companies?
So, in the S&P 500, people invest in it because it gives you that diversification. But since those big companies have grown so much, they kind of control an outsized portion of the S&P 500. And so those top 7 companies have really carried the S&P 500 over the past, year here. They've done really, really well, and they've kind of carried the S&P 500 up with it. One of the questions that a lot of people have now is that expected to continue? Do we think that those top 7 are still going to drastically outperform? Or maybe is it time for the bottom, 493 to start catching up?
Yeah.
So, that's one of the things that we've looked at. Maybe adding to some of our clients' portfolios is more exposure to those maybe smaller, mid-sized companies as opposed to just those top 7.
And so what really determines how well the company is doing in that? Is it just their own profit growth? Is it their revenue? Like, if those top 7 companies are doing best and well, then wouldn't it be smart for people to stay with them than to diversify, or do they kind of hold a monopoly?
Yeah, it totally depends on the future expected growth of those companies, right?
Okay.
So typically the market will treat your company well as if there is expectation of future dividends, future growth, future profit from that company. And so one of the things we look at is kind of what they call multiples for a company, which is how many multiples of earnings that company has that is built into its stock price. And right now, those largest 7 companies, which are all household names, it's Google, it's Microsoft, Apple, Nvidia, all of those big companies, their multiples are very, very high. And so some people look at that and say, hey, I think it's maybe a little expensive right now to invest in those companies. Maybe we want some with lower multiples that are at a little bit more of a discount.
Okay, so what is the biggest thing investors should do right now? Like, how should they navigate these waters?
Yeah, one of the things to look at is the overall diversification of your portfolio. There's probably a lot of people out there who, inside their 401k, they're invested in an S&P 500 index fund. And it's possible that doesn't give you as much diversification as maybe you think. And so one of the things is, you can add an exposure to some mid-cap companies, some small-cap companies, and that kind of broadens your diversification so that your portfolio isn't just determined by what Google does or what Apple does or what Amazon does. It's much broader than that.
So overall, would you say the market has done good, well, bad,
Yeah, no, I mean, it's been great. We love to see what it's been doing over the past year, and that's why, when the market goes up, it can be a good time to take a look and say, hey, am I out of tolerance in certain things? The S&P has done really well, and maybe this other fund that I'm in hasn't done as well. Maybe it's time to rebalance across those.
Time to rebalance. All right. Well, thank you so much, Caleb.
Yeah, thank you.
Appreciate it. And if you would like more information about Foster Financial, we'll have their phone number listed below, so you can give them a call for a complimentary consultation. And I'll see you after the break. This segment sponsored by Foster Financial.